May 4, 2011. Real Estate Capital Scoreboard May 2011. Chicago, Illinois, May 4, 2011. Real estate finance fundamentals are favorably gravitating towards borrowing as the triple play of lower treasury rates, compressing mortgage spreads and higher leverage levels fall into place. During the past month, 5- and 10-year treasuries dropped by more than 15 basis points, while lenders slightly tightened spreads to remain competitive as more capital floods the markets. Also, with values stabilizing for most types of income properties, funding sources are willing to offer additional proceeds. Current highlights include overall rates, with mortgages rates at historically low levels ranging in the 4% to 5.5% for longer-term debt. Borrowers prefer fixed-rate debt as pricing differential is barely significant versus floating-rate formats. That said, many lenders are removing floating-rate floors to remain competitive. Performance: the markets have bottomed out as nearly all property sectors demonstrate improved profitability. Apartments continue to outperform all other sectors as low home values and slow sale velocity challenge the residential market, making renting more attractive to the otherwise home buyers. In fact, for the first time in years, home ownership is less costly than renting in many markets. Hospitality is on a rebound with business travel on the rise. Office and industrial demand is up, although at cautious levels. Lastly, retail rebounds as slowly rising consumer leads to better store sales and expansion plans for retailers. Investors are noticing these trends as evidenced by bidding activities increasing substantially from last year and, in fact, approaching pre-recession levels for well-leased properties. Capital: throughout this spring, substantial funds are available for funding most types of income property real estate. Funding sources are keenly aware of competition for quality properties with cash flows. Pricing remains tight. Conduit lenders are definitely back in the market offering higher leverage, while life companies compete on pricing and agencies still dominate the multifamily arena. As profitability returns and workouts are successfully addressed, banks are back seeking new business as well. In general, lenders are more creative in looking at stabilizing assets, willing to bid earlier in the process to capture loans. However, funding projects with ongoing leasing issues is still a challenge. The Real Estate Capital Institute's Jean Peck suggests expect more liberal underwriting standards as lenders scramble for a limited supply of quality loans. She also believes capital sources are certainly lowering yield expectations, but sooner or later, more risks will have to be taken as well. This may include higher leverage levels and lower debt coverage.